Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Joe Tigay, portfolio manager over at Equity Armor Investments. We're going to discuss Nasdaq-100 volatility as well as the Fed's impact on liquidity. Joe, it's great to see you as always. Before we get into the impact with the Fed, you were saying a couple of weeks ago that even though we're rallying off the lows, once we do take a breather here, we could expect some volatility to come back into the market, and that's essentially what's happened this week.
Yeah, there's no question about it. Now, volatility, we all have to remember, is all relative. So it's all relative with what's happening recently. So even though volatility is at a level, maybe historically it seems high, given where it's been recently, it wants to go back to that recent mean. So volatility has a tendency to revert to the mean. If lately, since the pandemic, volatility has been higher, now that volatility was low last week, it had a tendency to want to turn around higher. So just on that first little hint of a sell-off we saw on Monday and Tuesday, we saw a big increase in volatility. People were ready to step in and buy protection right after we had a couple down days.
Right. So, Joe, historically, what is the average, around 15, 16 on the VIX, somewhere around there, perhaps?
Since 2000, a little bit higher, maybe closer to 20. And just, if you look from like 2011 to 2018, you might say the average is a lot lower than that. The average is 14 and 15. We saw a long period where volatility was low there. But since the pandemic, the average has been a lot higher. We've been over 20 almost the entire time since the pandemic. So it's always relative. It's been where we've been recently, and at 18 where we were last week, that was relatively low.
Yeah, and it's so interesting. And the reason for teeing up that question was perhaps the new ceiling is 20. I mean, the markets are certainly very different now than they were in 2011. And of course, I mean, Joe, for the past decade, the Fed has inserted itself into the marketplace, flushing the system full of liquidity. As it starts to dial itself back here, as a trader, you have to be, thinking about that. What is the impact to liquidity and to volatility now that the Fed is not in the system as much as it has been over the past decade?
Yeah, well, the amazing phenomenon there had been before the pandemic was that inflation just wasn't materializing. It was just a head scratcher forever and ever, and there never was inflation. We expected it to come. We thought it was going to come. And the Fed had a lot more tools in its playbook. When there's a recession and there's no inflation, it's really easy for them to speed up the economy. Now, what happens if there is a recession and there's high inflation? Now they know they want to cool off the economy. They know they want to get inflation down. I'm curious what's going to happen if the economy does cool down, but inflation does not. The Fed won't have the same playbook, and the market might take the hit because of it.
Yeah, and you know what? When we speak to you and Brian in the next couple of weeks, we're going to start to be in earnings here, earnest. And I think, while fourth quarter earnings were good, Q1 is going to price in the supply chain issues. Of course, you have Russia and Ukraine. Adding only more to that, the costs are going to impact margins at some point, whether it's a supply chain issue or whether it's input costs. So I think, kicking off with the big banks, that'll be somewhat of a tell with interest rates moving higher. And then, once we get down the road with tech and retail earnings, I think guidance is really going to be the key there.
Yeah, it's going to be really interesting to see. So far, we've known inflation has been high for maybe a couple of quarters yet, and that hasn't really filtered through to corporate profits yet. The profit margins have remained strong. So at some point, something has to give. Either profit margins are going to sink or consumers are going to run out of money because everything under the sun costs more money right now, and money is not infinite, as we know, and it's not like wages are going out of control when we have runaway inflation. So I think what naturally is going to happen is this inflation will cause the economy to slow down. Just something as simple as oil being a lot more expensive is just like a tax on the consumer. There's just less money to go around. At some point, consumers look around and they say, what do I need and what do I want? What I want gets cut out and what I need gets purchased.
Right. So, I mean, where do you hide out then? I guess consumer staples, as you think about your portfolio, what looks attractive at this point?
Yeah, well, the inflationary component to it is always there, though. So if there is inflation, equities are still going to be beneficiary. I just expect there to be more volatility. 20 being a floor for me is a reasonable spot. So yeah, I think having a balanced approach, having staples in there, having some protected some things protected against rising interest rates is important too.
All right, Joe, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.